So today we're going to look at break-even analysis. This topic is very simple and straightforward, and we're going to simplify it. We're going to address all the challenges that people usually have. So I want you to pay attention to every explanation that I'm going to give, because I've highlighted some mistakes that people make. Usually people don't get this question right because they make some simple mistakes, and I'm going to address those mistakes so that you do not make such a mistake. If you have made it before, you won't make it again. If you haven't made it, at least you avoid such mistakes so that you get all the marks allocated to this topic in an exam or a test. So for those doing strategic management accounting, advanced management accounting, managerial finance, as well as managerial accounting or management accounting, this course, or those doing cost and management accounting, this topic is actually there in all these courses. So get it from here and be able to apply when you're questioned in the exam, and get the hints and tips that I'm going to actually highlight as we are learning this topic in this video for today. So my name is Dr. Consistency from CourseMate Tutorials. We are a team of gurus that have conquered in specific fields. So I'm also inviting you to register with us for extra lessons in all courses: taxation, all the courses in first year, all the courses in second year, and all the courses that you may be taking in third year. So get guidance, you get materials, and intensive discussions on how to handle this exam in different courses that you're going to register with us at a fair price. So our lessons are conducted online, and I'll give the details of my contact details, so that we can talk to me on WhatsApp, and then let's arrange a deal, learn these courses, handle them with easy. So let's start at the topic. As I said earlier, my name is Dr. Consistency, and I'll be guiding you through break-even analysis. So break-even analysis. So first thing first, we need to understand what do we mean by break-even. Okay? So introduction to break-even analysis. So break-even analysis is the key financial concept. It is used to determine the level of sales or production needed to cover all the costs. Okay? That's the use, number one. 2, it provides insights into the point where a business neither makes profit nor incurs a loss. So at a break-even point, the business will neither make a profit nor a loss. So it will give this technique, or this concept is going to help a business to be able to have an insight at what point does our production or our sales never give us a loss nor a profit. So this one will help the business. So this analysis helps business to make important decisions regarding one, pricing of the product they produce, from the word production, cost of control of costs. Okay, so they will look at it and say, okay, at this point we'll never make a profit or never make a loss. So what do? Let's control the cost. This technique is going to help the business to make those decisions. Also profitability, to look at the profit. It is also an essential tool for planning and controlling operational activities. So this break-even analysis is also important for controlling and planning operational activities. Okay, so there are some key components of break-even analysis. So we need to understand. This is now hint number 1. Understand these terms that are here. Understand them, because they'll be very key when we start doing computation. You need to know what is a fixed cost, what is a variable cost, what do we mean by total cost, how do we calculate total cost, what is sales revenue, okay, and how do we calculate sales revenue. Okay, so fixed costs, these are expenses that do not change with the level of output, such as rent, salaries, insurance. So fixed costs, they do not change. Whether you produce a lot or you produce less, you don't even produce, the salaries of those permanent employees will be same. The insurance, you pay the same thing. There's no need, there's nothing like, no, this time we produced less output, we had less output, low output, so the rent, the landlord must reduce the rent. No, you pay the same rent. So that's a fixed cost, and these are examples. It is key to know the examples. Variable cost, VC. So costs that vary directly with the level of output or sales, such as raw material, direct labor, and sales commissions. So these are costs that changes with the change in the output. If you produce more, you need a lot of raw materials, and you need a lot of labor, direct labor. Okay, and sales commission also increase. If you're going to produce less, you won't need a lot of raw materials. So the cost of these will change with the change in the activity levels. Total cost. So total cost is the sum of fixed cost and variable cost at different levels of production. So total cost is simply you add the variable cost and the fixed cost. So it is fixed total cost, TC, is equal to fixed cost, FC, plus variable cost, VC. Sales revenue. So sales revenue is the total amount of money generated from the selling of goods or services. That's sales revenue. How much money have you obtained after selling your services, after selling your goods that you've produced? It will be called a sales revenue. Now, how do you calculate sales revenue? Sales revenue is given by selling price per unit times number of units sold. If you are selling at 10 quarter and you have sold 100 units, what will be the sales revenue? You multiply 10 quarter per unit times 100, so you get your 1000 quarter as your sales revenue. Okay, so we are very much interested in the calculation of break-even point. Already we are dealing with the break-even analysis. So break-even point is defined as a point at which the business does not make a profit, as well as at this same point it doesn't make a loss. No profit, neither profit nor loss is made or incurred respectively. So we can calculate the break-even point using two methods, graphical method and mathematical method. So mathematical method is where we calculate using formulas. Graphical method is where we use the graph. So let's see. Let's start with mathematical method, the formulas that are there in calculation on break-even analysis. So the first thing they'll ask you in exam or in a test or quizzes is to calculate the break-even point in units. So break-even point in units is given by fixed cost divided by selling price per unit minus variable cost per unit. Now I want you to understand this thing. What we have here, selling price per unit minus variable cost per unit, is the answer you get after this subtraction down here is called a contribution. Therefore, break-even point in units can actually be given as fixed cost divided by contribution per unit. Okay, I hope you get this one. You can also be asked to calculate break-even point in value. So, break-even point in value is simply fixed cost divided by contribution margin ratio. Okay, this contribution margin ratio, sometimes they call it contribution sales ratio. Okay, so contribution sales ratio. So how do you calculate contribution margin ratio or contribution sales ratio? Is simply the selling price, the contribution. So you've seen this formula say where contribution margin ratio is equal to selling price minus variable cost per unit over selling price. So what is happening here is that the top part here, this subtraction gives us a contribution per unit. So contribution per unit over selling price per unit will give us the contribution sales ratio or contribution margin ratio. But I want also to let you aware that this break-even point in value, you can actually calculate it as fixed cost over contribution per unit times selling price. It can also it will give you the same answer. Okay. Contribution margin. Now, this is very key. How do you calculate a contribution? This is where everyone, almost, they get this question wrong. Contribution is equal to contribution per unit. Let's define. Contribution is the amount of sales revenue remaining after deducting variable cost. You have heard. Sales revenue minus variable cost, we get a contribution. Okay. This is the amount they contribute to covering fixed costs and generating profit. So contribution per unit is given by selling price minus variable cost. Now the struggle is how to find the variable cost. That's where most people get it wrong. So let's see. But again, there's what we call contribution sales ratio, which is given as which is also known as contribution margin ratio. You can actually say contribution margin ratio is equal to contribution over selling price, of course, per unit. So I want to address on how to calculate the variable cost. Let's see how we do that. I'm going to address that at the end. There is a question that we're going to take. There's what's called margin of safety. So margin of safety indicates how much sales can drop before the business reaches a break-even point. It helps assess the risk level of the business operation. So margin of safety is simply actual sales minus break-even sales units, if they want you in units. But if they want in percentage, the same formula, you just divide by actual sales, then you multiply by 100 to make it a percent. Okay, that's it. That. So there's also, they'll ask you to calculate targeted units to achieve a certain profit. So required sales units, it will be given by fixed cost plus the targeted profit they'll give you in the formula, divided by contribution per unit. Now we understand that this formula down here, simply the result of this subtraction is a contribution. So targeted unit will be fixed cost plus targeted profit over contribution per unit. Alright. Targeted profit. Sometimes again they can ask you to calculate targeted profit. To calculate the targeted, okay, this is the same thing as what we are talking about. Or required, yeah, we can also calculate required sales as fixed cost plus targeted profit over contribution sales ratio. This is another formula apart from the one we are talking about in the previous. Note that contribution sales ratio or contribution margin ratio is simply this contribution per unit over selling price per unit. That's the formula which is key. So what's the importance of this? The importance is that it will help you in making pricing decisions. Since you are producing products, okay, or you are providing services, it will help you setting the right price to ensure profitability. Cost control. Since it will help you now it will assist you in identifying fixed and variable costs, then you promote better cost management. Now you know which costs have to be adjusted, the variable cost or the fixed cost, so you'll be able to make those decisions. Profit planning determines how many units needed to be sold to achieve a desired profit. We have seen a formula from there. So it will help you. If I want to make this, how can I make these ones adjust to make the profit? Then we have the risk assessments. Provide insights in the risk associated with the sales profitability. So we have a summary. So break-even is a path to in financial planning, offering business a clear understanding of sales levels needed to cover costs. It helps in pricing, cost control, profit forecasting, serves as a critical metric in decision-making process. Now there is this question that we are going to take in the next video, and I'm going to elaborate and illustrate on how you calculate the variable cost. So from now till then, stay abreast.